Well, folks, the stock market is losing it. I've put together here today a video for you guys that I want to go over a lot of what you need to be prepared for in the stock market in 22. There's very early action here we're getting just here in the first couple trading days that's giving us clues about what the stock market is going to be like in this year, 2022, and what you need to be prepared for. And I'm going to take you through a ton of different charts, a ton of different valuations out there, things like that to get you mentally prepared for what we're about to go through in 22. So hope you guys enjoy this. This took me quite a while to put all this together. I appreciate you guys joining me for this video. Make sure to subscribe to this channel if you're not already. Hit that subscribe button. It's absolutely free. If you're looking to learn directly from me in my private stock group, check out pinned comment down there. That'll be to fill out an application if you're looking to join that, okay? So, all right, here to give out the value, all right? So in 2020, obviously, if you got in the market at any point in the, March time, April, May, something like that, right? We know what it was, right? It was a great stock market. It was up and it was up and it was up and it was up, and it was very easy to make money. Let's just be quite honest, right? Very, very easy to make money. And I know a lot of you guys watching this video right now, you had an insane 2020. I know me personally, it was insane. Like, it was a triple-digit ROI type year. I aim to get 30 to 40% a year. So when I'm getting a triple-digit return, like, that's just ridiculous. Like, I don't remember what the number was. And we had a lot of people that were pretty new to the market and got like a 300% gain, 500% gain. Some of these folks would send me screenshots of their portfolios, and it was ridiculous. Like, these are newer investors to the market getting 300% ROIs, 500% ROIs, just crazy, right? But that's what it was in 2020, and so we were all kind of trained like that was, especially if you got in the market during that time, like that was what happened. Like, it was easy to make money in the stock market. Obviously, we know that's not really the way this game works, right? But that was, at least if you came into the market, that's what you knew, right? It was kind of like we felt like we're Mike Tyson in our prime, right? We're knocking everybody out. We're knocking the stock market out. It was just a different time period, right? And then we fast forward to last year, 2021, and what you saw was a massive amount of stocks just get destroyed. Basically, after February, from March on, a ton of these stocks that retail investors were in, what happened to them? Well, what happened was they completely deteriorated. Some of these companies either got way overvalued, way overhyped, and maybe just shot way too down to the downside, right? But nonetheless, I mean, the drops in a lot of these stocks was the worst I've ever seen being in the stock market. The worst I've ever seen. The amount of stocks that I saw that retail investors were in that dropped 50, 60, 70, 80% plus from their basically 52-week highs, I've never seen it like that, ever. Okay, that was a whole different situation, and part of that was because stimulus money was pumped out there. Part of that was because overhype in the market and just a lot of new retail investors getting in, and the hype cycle that was 2020 when everything was just going up and up and up, and it was kind of like, take the most risk possible and those sorts of things. And yeah, 78% declines in the past year. There's a lot of stocks that have those sorts of declines that are small cap stocks. We didn't see this sort of devastation in the large caps, and we're going to get into large caps in this video. We didn't see that happen in large caps, right? But we saw it across the board when it came to small caps. And so everybody in 2021 is, that's participating in this market. You almost have a complete opposite view of what folks had that got involved in 2020, right? You think the stock market's probably a scam that you just lose money over and over and over outside of buying big tech, right? Because you look at big tech and you're like, oh, big tech's easy money. And then you look at everything else, and especially small caps, and you're like, that's like the worst stocks in the world, right? You get in the market in 2020, it's like small caps are the best thing ever because those are going up hundreds of percent, right? Maybe 1,000% plus. You get in the market in 2021, you're like, small caps are the devil. Large caps are the best thing ever, right? And so it's just, that's a stock market for you in a 2-year time frame. Complete opposite situations, okay? Complete opposite situations. And this was like, when Buster Douglas knocked out Mike Tyson, and that was, any of us that were in small cap stocks in 21, that's us laying on the canvas just like, this is so painful. We just got knocked out, right? And here we are, in the first few trading days here of the year, and we're starting to get some signs, some tells about what the market's going to be like in 2022 here. If you look at Tesla stock here today, so think about Tesla yesterday. Tesla had a phenomenal day, and it deserved to have a phenomenal day, right? Because the company reported ridiculous delivery numbers, production numbers, all right? And so it has a great day yesterday, and all of a sudden here today, it drops $52 a share, $50 plus a share. It's not like it's a small amount, right? When you drop $50 plus, like I said, it's not a small amount. And so it's like, wow, Tesla just gave they didn't give back all its gains it had yesterday, but it gave about, a pretty good chunk of those gains we got in the stock yesterday. It just gave it up today. And it's like, wow. If anything, you would expect it maybe Tesla to run again a bit, because if you've been tracking Tesla for the runs Tesla goes on, I mean, it will go on several days, if not a week straight, of just up in big up moves, right? And so all of a sudden you get a day like today that it was like, well, in the past, sometimes you'd get another 3, 4, 5% upward move. And no, we didn't get that today. We got $50 plus down here today, right? Look at Smile Direct Club, STC. So this stock had a tremendous day yesterday, but here it is. Today, it gives back a lot of the gains. It did not give back all the gains, but it gave back a lot, okay? And that's the same story with Tesla, right? Gave back a lot of its gains. Didn't give it back at all, but it gave back quite a bit, right? Look at Oatly. So Oatly, going into Monday morning was $7.92. Now it's trading at $7.99, and that was after yesterday was trading at 8 and some change, right? $8.41 is where it opened. And look at Oatly. It just gave back a ton of its gains, right? And so you're seeing this stock after stock after stock, especially when it comes to small caps. Look at Corsair, tremendous day yesterday, but just gave up a bunch of its gains here today. It hasn't given up all its gains, but it gave up a bunch, man. And it's stock after stock. And then we just have Tattooed Chef just to fry our brains, essentially. Tattooed Chef yesterday, it finishes somehow down when almost every small cap out there was up. And then here today, all the small caps are going down, and somehow Tattooed Chef's up 3 cents. Like, what? Okay. My son, by the way, one of my children, he saw me, prepping this video, and he saw this, and he goes, oh, Tattooed Chef's only up 3 cents? That's bad. And I said, son, listen, okay? In Tattooed Chef, we take what we can get, okay? If it's 3 cents, I'll take the 3 cents, man. I'll take what I can get in the chef, all right? Don't hate on the chef. I'll take a 3 cent gain, whatever it is, as long as it's not down, right? And so I don't know if you guys ever seen one of those classic heavyweight fights, right? Where, it's just like two guys and they keep, just punching, right? And it's like one guy nails the other guy and then the other guy, nails the other guy. And it's just like back and forth, and you're just seeing punch after punch after punch. And you start to think, well, these punches, it's just like no one's really winning the fight. They're just, landing a punch and then the next guy lands a punch. Well, it doesn't really work like that, right? One guy could be punching the other guy way harder than the other guy, right? And so in this sort of market, it's really about being the guy that's getting the better punch, right? And if you're going to have this sort of volatility in the market, all that matters, right, is that you're having more upward moves for your stocks and downward moves. You're going to get hit, right? Kind of like in a boxing match, you're going to get hit, but as long as you're not getting hit as hard, right? That's what's important. Now, why is this happening, right? I think that's really, really important factor to keep in mind. Well, there's many various reasons why this is happening right now. I don't know who keeps track of these sorts of things anymore, but I do on a daily basis. And we had, for the first time ever, I guess we should congratulate ourselves in the United States of America, over 1 million new cases of Rona. Over 1 million, a number that most folks thought we could never get that high, okay? Woo! Wow, that's a record. That's all I'll say about that. Over 1 million new cases. So obviously, in this sort of situation, you're going to have, worries in the market like, oh my gosh, like look at how insane these numbers are getting, right? And could we have closures of anything? You're just going to have a lot of worries, right? As far as me, and I think a lot of, I would call it more intelligent fund managers or investors or whatever, I think the way most people look at this, they start running numbers and they're like, dude, these numbers are going to drop off a cliff, likely starting in February and moving through the spring because it's going to have gone through everybody. And if you haven't gotten it by the end of this winter, okay, then the odds of you getting it are going to be pretty darn low, especially as the weather warms back up. So the way I look at this, and I think the way a lot of folks that are educated on this look at this, is it's running through everybody right now, basically. And like I said, February, these numbers are going to start dropping in a massive way throughout the spring. And then I think life is going to be pretty dang back to normal. Mask mandates are going to go away and all those sorts of things. Once again, I'm not a doctor. I just look at numbers and just kind of view it from a psychological perspective on what I think, states and basically the government's going to do in this situation. And I think life's going to be back to normal by the late springtime, early summertime. And so you have one side where it's like fearful. The other side is like, you think about this logically and you're like, okay, if this is as many cases going on, it's going to have run through everybody. Everybody's going to have gotten this crap by the end of winter, basically, right? It's just good. That's just like how this sort of situation works. And if you haven't got it by then, you're likely not getting in at least in this year, right? 2022. So as far as, is running around long term, that's all, a big debate out there. But as far as this whole situation we've been in for the last 2 years, that's likely coming to an end, likely within the next 3 to 6 months. Okay. And then you have this situation, right? Elon Musk is asked when's the next recession. Elon Musk's the richest person in the world, so his words hold weight. Just bottom line, it doesn't matter what he speaks about; it's always going to hold weight, right? When do you think the next recession will be? Elon Musk says predicting macroeconomics is challenging to say the least. Well said, Elon Musk. Okay, he says my gut feel is maybe around spring or summer 22, but not later than 2023. All right. Now, obviously, Elon Musk deserves a lot of respect, being the richest person in the world and being a great businessman. But to be quite honest, his guess is just as good as anybody else's guess out there. It's, you can't predict these sorts of things. I've watched, people, person after person try to predict we're going to have a recession this time, that time, stock market crash, those sorts of things. You just never can predict it. That's just the bottom line. You maybe get lucky, and it's very entertaining to listen to people try to predict recessions. Very, very entertaining. But at the end of the day, no one really knows. And there's people that study this stuff all day, every day of their lives and can't even predict recessions, right? And so, but at the end of the day, if you have the richest person in the world try to make a prediction like that, it's going to cause some kind of worries out there, like, what could happen here? And this time of year is exactly when everybody makes their predictions, right? About this is going to happen. And the way I kind of think about this, trying to predict a recession is it's kind of like watching ESPN. I don't know if you guys ever watch those debate shows if you're into sports and like to try to debate who's going to win the next game, right? The only difference is with that, one of the teams has to win the game, right? So there's a high probability somebody's going to be right because everybody's trying to predict the game. But with this scenario, the way I think about this is it's all entertainment when you're listening to anybody trying to predict macroeconomics and predict a recession. That's what it is. It's all entertainment. And, the way I think about this going into every year is it's always a possibility you could have a recession, and you should always, have some cash around in case that happens, right? But at the end of the day, the way I think about this is, we're likely not. That's just the bottom line. Like every year we go into this, we're likely not going to have a recession because that's just not the way things work. In most years you don't have recessions, and but you got to be prepared for it, and you should always think about it, right? And so I think Elon Musk, he should always have that in the back of his mind. Like every great business person, they should always think, okay, what happens if the economy weakens? What happens if we have a recession? Something like that. That's being a prudent CEO of a company. You should always be thinking about that and be ready for the roller coaster ride that is, macroeconomics, right? So that's that, right? Then you have this scenario, which, I've covered a few times on the channel over the past, 2 or 3 months here. This is looking at Yardeni Research. We're looking at forward PEs for the S&P, indexes. If you look at S&P 500 large caps, we're basically, we're out of the range we should be in, flat out. We should be much lower than this. 20 to 30% lower than this we should be at, basically, to be in a normal historical range. So large caps are out of whack. As far as mid caps, they're in where they should be, okay? S&P 400 mid caps, we're right where we should be as far as mid caps go, so that's healthy. So basically the way to think about this is unhealthy large caps, healthy mid caps, and if you look at small caps, we're under where we should be. So if you look at small caps, that's where the opportunity is. That's why I've been investing so heavily in small caps the last several months, right? And throughout the whole back half of 2021, almost every single stock that I've been putting major money in has been small caps because that's where the real opportunity is. And I'll go wherever the stock market takes me for the opportunities, that's where I'll go. If it's large caps and that's where the opportunity is, I'm going to invest in large caps. If it's big tech, I'll be buying big tech. If it's mid caps, I'll be buying mid caps. And if it's small caps, that's where I'm going to be. I'm going to be in S&P 600 small caps or Russell 2000 or whatever, right? That I'm going to go where the market takes me at a given time, wherever I see the opportunities. And if you look at these charts, we're out of whack there, we're in range where we should be there, and we're way under where we should be there, okay? So this causes a dilemma where folks look at this and they say, well, large caps carry so much weight, so if large caps got to come down 20, 30%, imagine what that does to S&P 500, what that does to NASDAQ, right? And so I think it is something to consider that if we were to come back in range. Now, the other thing you got to consider here is a scenario where large caps don't move much at all for a year or two. So maybe they don't decline, but they don't move as far as stock price. But meanwhile, the profitability of the companies increases exponentially over the next year or two. And so all of a sudden you get back in range where you should be, not because the stocks went down a bunch, just because like the company's earnings went up a bunch, right? And so you get back into the range you should be. Now that's definitely very much a possibility. And so that's something you should also consider, is the fact that these stocks don't go down in any major way, right? So that's where you get some more conflicting stuff, because it's like, wow, opportunities are there, opportunities are here, opportunities are hard to find in the large cap land, right? Then you look at something like this, right? Apple just hit a $3 trillion market cap, first market cap to ever hit that for, a company, right? It's incredible. So Apple hits a $3 trillion market cap, becomes the first company to do that. But the issue with Apple is we know moving forward, Apple's going to have likely a lot slower growth than any time in its history, right? It's just a lot of large numbers. It gets hard for Apple to continue to put up some insane numbers. And look at what analysts have this company growing revenues for 2022. It's not impressive at all, to be quite honest. But the issue with Apple is this is a stock that usually trades in a range of a 10 to a 20 PE ratio. That's where it's been at for like a decade, right? But here we are in this scenario where Apple's trading between a 30 and a 35 PE. So Apple's going to grow substantially less than any time in the past decade moving forward, and yet its valuation is substantially higher than any time at its history. And so that makes you look at a stock like Apple and it makes you a little fearful. Now, you could also make an argument that maybe Apple was too undervalued here based upon its great business model of just the recurring revenue streams and the fact that if my iPhone breaks, I'm going to go down to the Apple store and buy another iPhone. That's huge. That's huge, for a brand, right? If somebody can just continue to buy your product. If my MacBook stops working, I'm going to go buy another dang MacBook, right? And if they come out with better products and services, I'm going to buy those products and services, right? So you can make an argument that it was always undervalued. But at the end of the day, it's not a good look when you have way less growth moving forward for a company and you're trading significantly above where you've ever traded at in your historical ranges. You have to go back to, literally, you have to go back to iPhone days when iPhone was just starting to come out, and think about the growth Apple had over the next decade, right? The next decade plus. And yet you have to get to those sorts of ranges. That makes Apple a little scary. And remember, this is the heaviest weight stock in the stock market, right? So some people look at this as that's something to be fearful of. You look at Mr. Softy, right? Mr. Softy usually trades at anywhere from a 10 to a 20-ish PE ratio in historical ranges. But recently, it's trading significantly above that. Now, some folks would say, well, it deserves to trade above that because, Satya Nadella has done a great job with Microsoft turning that around, making it more of a subscription-based business model that's what's seen as a very, very safe business model, right? So you could definitely make arguments like that, but at the end of the day, you look at the numbers and you're like, we're trading significantly above, and this is the second biggest market cap in the world, Microsoft. So if Microsoft stock weakens or doesn't even go anywhere, it's going to hold the markets back, right? Something very important to keep in mind. Look at NVIDIA. NVIDIA has become a huge company now as far as its market cap and become a heavyweight in the stock market. NVIDIA usually trades anywhere from about a 20 PE to maybe a 40 PE. That's where it's historically traded at. And obviously, if you look at NVIDIA moving forward versus NVIDIA in the past, right, they're not going to have as much growth. That's the way things work, right? It's like you become a bigger and bigger company, and it gets harder and harder to keep growing the way you were growing in the past, right? And yet we look at the valuation of NVIDIA, and it's trading significantly above any time period in the past when it had a lot better of a growth story in front of it, right? So you look at that and it's like, wow, NVIDIA, what if this stock kind of fell in any major way? And then you look at a stock like Tesla that's now a $1 trillion market cap, right? 1.2 trillion market cap. And Tesla's a crazy stock because it's still in price discovery mode. Whereas a lot of these stocks, they've been making profits for a long time. If you look at NVIDIA, Apple, Microsoft, a lot of those stocks we just went through, they've been making huge net income and profits for a long time, right? And so you can look at historical ranges and you can look at that and you can be like, well, we're trading above, much above historical ranges. With Tesla, we don't have historical ranges to look at, right? So it's still in price discovery mode because Tesla's, they were unprofitable for the longest time. They barely just got to profitability. So Tesla's in price discovery mode right now, especially if you're looking at PE ratios. And so this is why a stock like Tesla is a crazy stock, because this stock, if it was a $2 trillion market cap at this time next year, I wouldn't be surprised. If it was a $500 billion market cap, which would be over 50% downside from here, I also wouldn't be surprised, because when you're dealing with the price discovery stock, those are some of the most volatile stocks you can ever deal with, because people are trying to figure out, like, what is a fair value to place in this company. We know you can't just say, well, it deserves to trade at a P like the market trades at, because this is a company that's growing so much faster than anything else, especially if any of their peers, right? So you can't really value it like that. If we look at price to sales ratio for Tesla, I mean, obviously we're trading way above where we usually trade at with price to sales ratio. However, on a forward price to sales ratio, this company's probably at around a 15 right now. Now, you would look at the past and it was like it traded in a 1 to 3 range as far as price to sales ratio. But also remember, at that time, this company was likely significantly undervalued, right? Because everybody looked at Tesla at that time as a huge risk, and there was talk of bankruptcy and blah, 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 and it was kind of ridiculous, the ranges it was trading at back then, right? Now, once again, this is in price discovery mode, so everybody's got to try to figure out, is this a fair value here, or is it not a fair value, right? And that really comes down to the eyes of the beholder at the end of the day, right? And so when you're looking at this sort of market, right, we're in what I call a kangaroo market, where it's going to jump around. You're going to have a lot of price movements. It's not really necessarily an easy money market we're going to be in. And the name of the game in this sort of market is patience, okay? Patience is what is key in this sort of market, because you're going to have a lot of fluctuations in these stock prices. You're going to have, all of a sudden a great day, and then all of a sudden the stock gives back a bunch of its gains or more of its gains, right? And in this sort of market, it's just about earning more and your stock going up more than it's going down, right? And so if you're looking at some of these stocks, don't expect them to fly to the moon tomorrow or something like that. If that happens, that happens. But the name of the game is just getting more gains in these stocks each and every day than you're losing, right? The other name of the game in this sort of market is not to get impatient in this, or start thinking, well, if these stocks are just going up and down, maybe I'll start day trading it or something like that, because that's more than likely not going to work out very well for you, okay? The name of the game is just focus on the long term. If you see these stocks at, undervalued prices, and you love the price it's at over the next 3-5 years, you buy some more of that stock, okay? And you don't get frustrated because the stock doesn't fly to the moon tomorrow or something like that, guys. I think that's very, very important in this sort of market. We call this market a kangaroo market, all right? And the name of the game is just to make sure the punches are a little harder than the other guys punching you, okay? So I hope you guys enjoyed this video here today. I hope you got some good value out of it. Much love as always. Don't forget to subscribe to the channel if you're not already subscribed, and hit the notification bell if you want to be notified every time I drop a video. Much love, and have a great day.